Right, today's video is going to take on the sexy sounding Operation Twist. This is rumoured to be the Federal Reserve's latest attempt to boost the flagging US economy. Now, I'm going to make reference to a few bits of jargon in this video, and if you get lost at any point, just refer to my other videos on those topics, as I won't be necessarily going back through all the basics in order to talk about Operation Twist, but I will point you to the other videos that are worth a look. Okay, so what's going on? Why call it Operation Twist? It's actually quantitative easing 3. For anyone wondering what quantitative easing 2 was all about, take a look at my video, What is QE2 all about? But in essence, the Federal Reserve is trying in the US, this is a US operation, or rumoured to be a US operation, the Federal Reserve is going to try to stimulate the US economy. Now, how do you do that? Well, their theory is that you need to lower interest rates. You need to make it cheap for Americans, that's businesses and consumers, to borrow. If you do that, they will borrow, and that will mean that they can spend money and stimulate growth and all those other good things. So that's the theory. Now, in terms of how you go about lowering interest rates, well, Operation Twist is an attempt to do just that. Now, before we jump in to what actually is the Federal Reserve going to try and do, when is a good question. Some of this stuff is still not 100% certain, but sometime in the next month or so seems likely, but the Fed have yet to actually commit and say this is definitely when we're doing it. So Operation Twist is in the pipeline, as it were, but yet to be formally declared a policy, and in terms of the auctions I'll talk about in a moment, we don't have specific dates yet. Okay, so what is this thing? It's quite an important attempt to stimulate the economy, and it's based on buying and selling bonds. So I have done a bonds basics video, which I'd urge you to have a look at, but as a very quick recap, there's an important point at the heart of what the Fed's about to try and do, and that is bonds and bond yield. So it's important to understand one thing, which is most bonds carry, that's government IOUs. In the US, they're known as treasuries. They're pieces of paper, if you like, or electronic bits of paper. They're IOUs, and two things about them that are important. They tend to carry a fixed interest rate and a fixed redemption date. Now, the reason I mention that is if the interest rate on a treasury, let's say it's a 6% 30-year bond, is fixed, as is the redemption date, then it will be influenced by inflation and interest rates in terms of its overall price, because investors know they're getting a fixed income paid by the US government, and they're getting it for a fixed period of time. Now, that could be 2 years, 10 years, or 30 years. But those are important pieces of information, because what it suggests is that basically these things have a yield. So the total return on one of these IOUs is a mixture of the fixed income you get and the fixed redemption date. If you like, in other words, it has a life before it's bought back by the government that issues it. And what that tends to mean is that these IOUs have a sort of inverse relationship with inflation and interest rates. That is to say that as inflation and interest rates rise, the price of these things tends to fall, and vice versa. They're all backed by the US government, so the default risk is thought to be fairly low, but there's always that price risk on the longer dated ones. So in other words, if you commit to hold one of these things as an investor and it's fairly long dated with a fixed interest rate, in other words, you're not going to get any more or less interest no matter what happens, it's going to be that fixed 6%. The longer dated these things are, the riskier they're perceived to be, because you're locking your money away for longer with the government by buying one of these things and therefore taking more risk. So the price can fluctuate more between now and, say, the 30-year redemption date than it would on, say, a 2-year. So short dated treasuries are perceived to be relatively low risk, they're backed by the US government, their price is fairly stable. Longer dated, still backed by the US government, in fairness. So relatively default risk-free, although not entirely, because Standard & Poor's downgraded the US government recently, but the price risk is that bit higher. And that's reflected in the overall return investors expect to get for investing. So just before I dive into Operation Twist, just worth making the point that if you're looking at, say, a short-term 2-year treasury, you'd expect, all other things being equal, it will have an overall lower yield, and I addressed that in my bonds basics video, a lower yield than, say, a 30-year treasury, which is another IOU with a fixed interest rate. And if you look them up, you find that's the case. So right now, if you're locking your money away with the US government for just a couple of years, by buying one of these IOUs, you're getting an interest rate just above 0 in yield terms. In other words, the total return, again, check out my bond basic video if you're not sure how that's calculated, is just above 0. On the 30-year, it's not fabulous. These things carry a fairly low overall rate of return or yield, but it's more like 3.3%, let's say. So in other words, these are IOUs backed by the US government, and they carry a different total return depending largely at the moment on how long there is to go between now and the date the US government buys them back. Right, that's background. The Operation Twist is going to involve these IOUs. It's going to involve both the short dated ones and the longer dated ones. Exactly which ones we don't know yet, and we won't know until details of the programme are fully published, but that's the principle. So what exactly are they going to try and do? Well, the answer is very simple in theory. Twist comes from the 1960s. It's actually a dance craze, and back in the 1960s the government in the US didn't start dancing, but it attempted something to do with these IOUs. It attempted to twist the yield curve. If you're thinking what on earth's a yield curve and how do you twist it, I'll deal with that in just a moment. But in short, it's going to do two things simultaneously, and that'll require two bond auctions, as they're called. It's going to attempt to sell some of those and buy some of those. Alright, so unlike QE2, QE2, if you like, was sort of half of this. Quantitative easing, as we've seen it up until now, was printing money in order to buy bonds. This, in theory, doesn't involve any more electronic money printing or money creation. It's selling short-term stuff to buy long-term. So you'll hear expressions like balance sheet neutral being thrown around by commentators, and that just means that the Fed is, in theory, going to use the proceeds from here, if that makes sense. So there'll be an auction where they sell, and that'll obviously raise some money in theory for the Treasury, the Fed, sorry, and they'll use the proceeds to buy the longer dated stuff. So selling this to buy that. Why? Then we'll look at the reason it's called twist, because it's got something to do with the way the yield curve, which looks at the relationship between short dated yields and long dated yields, will move after the operation's been completed. Okay, here's the objective. Right now, the US Treasury think lots and lots of people want short dated IOUs. And basically, there's demand for these because everyone wants safe havens for their money. So basically banks and so on are on the lookout for a safe place to park their cash. And the 2-year IOU is thought to be a good place to do that. It's nice and safe, it's nice and short term, so the default risk and the interest rate risk are fairly low. Okay, meantime, yields out here at say 3.3% are thought to be too high. So the objective is to create more of a safe haven and also bring down longer term interest rates on the longer IOUs. Why do you want to do that? Well, the theory, and it may not be the 30-year they might buy 10-year or 7-year, the theory is that the yields on these things have a heavy influence on interest rates elsewhere in the economy, or borrowing costs elsewhere in the economy, if you like. So these set a sort of benchmark, if you like, that can be used in terms of mortgage rates, the interest rate ultimately you pay on, say, a mortgage, and also other types of loan. So the theory is, if you buy these things, you will compress the yield, you'll drive the price up and the yield down, and if these are used as a reference for medium to long-term borrowing rates in the US economy, that will reduce those interest rates for everybody else. And if everybody else enjoys lower borrowing costs, then they'll be more inclined to borrow and spend, so it'll stimulate demand. So that's the idea. Increase the amount of short-term IOU paper around, if you like, and decrease the amount of long-term IOU paper around, with the overall objective, basically, of not doing any more money printing, and secondly, lowering long-term interest rates. Right, let's just take a quick look at why it's called twist. It's to do with what this will hopefully do, thinks the Fed, to the yield curve. So I've done a video on yield curves, so I'm not going to go right back to the beginning and teach yield curves again. Have a look at that video if you're not sure. But here's the principle, and this at least explains the bit about why it's called twist, and then we'll ask the vital question, is this going to work? Is there a point to it? Okay, so let's just take a look at that twisting of the yield curve. Let's see how that's going to work. So basically a yield curve is simply, a graph that has time on one axis and yield on the other. And what I could do, is time means if I'm plotting different types of government-backed IOU, so treasuries, I could do something like this. I could say, well, 2 years is about there, 10 years is about there, and 30 years, and I'm being a bit artistically free with the length of the axis and so on, but that doesn't matter too much for the basic principles. 30 years is out there. And if I was to look up yields, well, the 2-year yield at the moment is very low, just over zero, so 0.2% or something, be about like that. On a 10-year treasury, hovering around 2%, so that'll look more like that. And on a 30-year, 3.3% would look something like that. Now, lots of artistic license going on here with the plotting, but that doesn't matter too much. So the curve is upward sloping. No prizes for guessing why it's called that. Left to right, okay? And all that's telling you, that's just a visual representation of some numbers about IOUs, is that if you buy 30-year as opposed to 10-year or 2-year IOUs, as an investor, you're tying your money up for longer. There are risks associated with doing that, so you expect a higher yield in return. Okay, so the normal shape is upward sloping, if you like. What Operation Twist, in theory, will do is this. Remember, what they're going to be doing is selling short term, I've picked to you as an example, but selling short-term paper. What will that do? That will increase the supply of it, okay? And if you increase the supply, all other things being equal, you're going to bring down the price, and that will push up the yield, bearing in mind the interest rate on these things is normally fixed. So if you start pushing up the yield, the line will move up a little bit. How far is a good question. No one knows the answer to that question. Equally, if you then buy with the proceeds, as the Fed, if you buy the long-dated paper, in theory, this is what should happen. As the Treasury starts buying it up, that decreases the open market supply, if you like, and that will tend to push prices up and yields down. All right, because you're basically making this end of the market even tighter as the Federal Reserve, by buying paper and sort of taking it out of the market. So increased supply there, decreased supply there will tend to do that, because prices for this stuff tend to rise, yields tend to come down. So the curve is twisting. Okay, probably not as much as I'm suggesting here, but it's twisting. It's flattening. And you'll hear that expression used from time to time. Okay. Now, so what? That's just a graphic representation of what I said before. The point is, what is the point? Will it work? Why are they bothering? Okay. The Federal Reserve feel they need to do something, clearly. The American economy is still throwing out some fairly grim data, jobs data, housing data and so on. So they feel that quantitative easing in its traditional senses hasn't pulled the economy out of recession. So this is a sort of QE with a twist, if you like. This is another attempt to stimulate the US economy by bringing down long-term interest rates. Here are the problems. Okay, number one, interest rates are already at historic lows and the economy isn't really reacting. So do they really want to try and bring down rates a little bit further? Is there any real purpose to this constant harping on about lowering interest rates when interest rates are already incredibly low? Variations of this type of thing have been tried in Japan for years to little effect. Because the problem is basically you can make credit as cheap as you like, but people are not necessarily going to borrow if they're nervous about jobs and the value of their properties. So a lot of people would argue that you can make money as cheap as you want to make it, frankly, but you've got to solve the underlying problem of employment, because without a job I'm not going to go out and borrow. So there are those who would say, and I tend to agree, well, how much lower is there, can interest rates realistically go? I mean, down here they're virtually zero, out here they're not, but they're still historically at very, very, very low levels already. Okay, so that's sort of problem number one, if you like. Logistical problem number two, which is more of a technical one, is what are they going to buy? 30-year, 10-year. That's really a sort of decision for Ben Bernanke at the Fed. But in terms of the overall impact on the market, what are they actually planning to buy with the money they raised from these auctions? And the third issue really is, how is the Fed ever going to reverse all of this sort of money printing that's going on in QE1 and QE2, and then this twist in QE3? Because there are those that would say they are just setting themselves up for a big problem later at no particular overall benefit to the US economy, because it's all very well for the Fed to keep buying these long-term bonds, all right, but then if inflation takes off, they are then stuck, if you want to see it that way, holding paper that's steadily falling in value, because inflation tends to erode the value of fixed income debt. So longer term they may be setting themselves up in balance sheet terms using QE1, QE2 and this version of QE3 for a bit of a headache, and in the meantime the US economy isn't creating any more jobs, the housing market isn't recovering. So one could ask the question, therefore, was it ever worth doing in the first place?